everyone, welcome to a new video on sectors and sector rotations for Tuesday, the 11th of June. I'm recording this just after the market closed, and I want to talk about the sector rotation model in this video. It's been a while. We stopped doing that when we stopped Sector Spotlight. I did that like every quarter, and I would like to pick that up because I think it's a good kind of longer term perspective to see where current sector rotation and the theoretical sector rotation model are aligning or not aligning, because that's also a message. But before I do that, market just closed after a nice dip at the start, and then during the day the market rallied again. So the S&P again picked up like almost 30 basis points. And if you look at the composition of that rally in the sector summary here, it's quite magnificent, it's quite remarkable. It's technology and communication services. There's only two sectors that are putting in a positive return, and all the others are negative. But what struck me especially is this market factor grid, because we've talked about the breakdown of growth and value stocks into the size segments. And if you remember, pretty much the only segment that had a positive outlook was large cap growth. And let me bring that RRG back into your memory. So this is the RRG that plots six tails. We have large cap growth, large cap value, mid cap growth, small cap value. And as you can see, all these tails here rolling over, going negative. 1, 2, 3 inside lagging, small cap value, mid cap value, rotating out, inside improving, moving towards lagging. And only one is moving into the top right corner, and that is large cap growth. And look at what happens today. Pretty much the only serious gain in large cap growth. Yep, it pushes the market up. Yes, it puts in a gain for the S&P 500, but that base is getting narrower and narrower, and that is something that I really think we should at least be aware of. Put in the back of your mind. For me, it's definitely a warning signal. If you look at the NYSE, Toronto, Nasdaq is higher, S&P is higher, Dow is down, mid cap is down, small cap is down. It's really a very narrow market. Anyway, enough of that. As I said, I want to talk about the sector rotation model, and just to bring that back in memory, let me jog that a little bit. You can find the sector rotation model, the theoretical sector rotation model, on the page where we have the perf charts on Stockcharts. So if you go to perf chart and you just stick in XLF, doesn't really matter. And then you select the S&P sector ETFs, and below that you will find the sector rotation model. And we're going to fill this in. I'll show you an image with the annotations in a minute, but this is what we're talking about. So first I'm going to look at these four macroeconomic indicators, metrics if you wish, figure out where they are and how that resonates, what that means for their positioning in the sector rotation model. And then we'll take a look at the current sector rotations and try to put a stamp or an opinion on these sectors and see if and how that aligns with the current market rotation. For this exercise, I'm using a ChartList, which, by the way, is a public chart list, so you can subscribe to that on Stockcharts, and you'll find these charts and a few more. The first ones are referring to the sector rotation model, and then the other charts in there are the monthly charts for the indices, which I, by the way, used last week when we did the monthly outlook. So here is the consumer sentiment index, and here are the 4 phases of the sector rotation model. And what I'm going to try to do is kind of put a stamp on what the current price action means for this chart. And this is quite a tricky one, I've got to say, because it's coming down hard, so you would be, you know, tempted to put it as falling sharply, making it a early recession. But I think this is because it's a longer term chart. It goes back to the 1980s, and we're looking at longer term trends here. So I'm going to put this as reviving or rising, probably more like reviving, which would be put it in a full recession, which is the first part of the sector rotation model. But it's a sine wave. It continues back and forth. So this one would be for me full recession, maybe early recovery, but probably a full recession. If I go to the next one, that is industrial production. And this one is clearly a flat. So this is a flat line here. I think that everybody will agree with that. And that puts IPI into full recovery. So full recovery in the model for when you just look at the industrial production number. Now we got interest rates, and interest rates are interesting because look at what happened here. This is a massive downtrend that has been reversed. So interpreting this chart, I'm going to say that this is rising. There is no rising, it's rising rapidly, and I think that's pretty accurate. It's rising quite rapidly, especially if you compare it with, you know, the move that we had since the early 80s. I think this is a rising rapidly chart, or rapidly rising chart, and that puts it into full recovery. That is where interest rates align with the sector rotation model. And then the fourth and final chart is the yield curve. We looked at that a lot, and it is still inverted. And by now it's been inverted. Look here, this started to invert in July 2022. I think this is like late 70s, early 80s. We had a huge inversions. And then we had a few small ones, but that was only a couple of months. And now we're here. So this was November 1988, and then we got out of it in less than a year. And here, this is Feb 2000, and it's December 2000. So that's also less than a year. Same here, also less than a year. And then here, we started to invert in July 2022, and it's now almost July 2024, and we are not out of it yet. We're still very much inverted. We were very deep. We were at the lowest level of the last 30 years, and now we're at levels that we saw in 2000 and maybe 1989. So still very much an inverted yield curve, which in terms of the sector rotation model means an early recession. Now the next step in the sector rotation model is to figure out, because that's what it is, figuring out in what sort of state the current sector rotation is. And because this is looking at longer term rotations, I am using a combination of weekly and monthly RRGs to get a better handle on what's going on. And I'm also using the equal weight sectors to better reflect the underlying rotations in the market, not so dominated by only a few stocks. And just let's work our way through it. I've selected ranked them on their name, so we can actually take a good look. And here we have communication services. And the monthly is clearly rolling over, while the weekly is improving inside weakening. But this is the longer term trend. So I can I can totally see how this weekly would roll over and get back in sync with the monthly. So for me, this is like an orange annotation. So I'm doing green for outperformance, red for underperformance, and then orange for outperforming and rolling over, and blue for underperforming and starting to improve. So here for communication services, I have put that as a red one because it is rolling over here, and this is definitely, you know, it's going to be very, very hard for this weekly tail to push that monthly into the leading quadrant. So communication services, I'm going to put as an underperforming sector. The next one is consumer discretionary. And what you see here is that the monthly is in leading but rolling over and starting to lose relative momentum, whereas the weekly is inside lagging and starting to pick up. So that's a bit of a contradictory, and it's coming out of a strong situation because this used to be, you know, a pretty strong sector, and now it's rolling over. So I'm coloring this one as orange. Was good, is getting into danger, is rotating out of favor. And here is consumer staples. That's a difficult one because the long-term one is still inside lagging, but it's kind of starting to pick up. And the weekly has rolled over inside improving, so it's probably going to go through another rotation on the left-hand side. But the monthly is starting to pick up, so it's probably a very light blue improving sector. We go to energy. That is, I'm going to say dark orange because the monthly is rotating out of favor, and you can see that the weekly rolled over and is now starting to accelerate lower. It's not super negative yet. There's still a possibility that this weekly will curl back up and it will drag the monthly back up, but the sector has had its best time for a little while. So again, this is an orange sector, so it was very good and it's now at the danger of starting to underperform. Here is financials. That is actually doing pretty well in terms of the monthly, so that is a very strong tail for the monthlies. And then we have the weekly, which is rotating out of favor, not too much negative momentum. So this is definitely a blue one. Could have been green, but a bit careful. But I'm going to rank this sector as potentially improving and potentially going into an outperformance mode in the next couple of weeks, maybe months. So here's healthcare. And if you look at healthcare, that's actually starting to curl up. Still, it's inside lagging, but both tails are starting to move up. So that's definitely a blue. That's like it was in a very negative situation, and it's now starting to pick up. And that makes it definitely a blue sector, you know, potentially improving in the coming months. And then here is industrials. Monthly was very strong, but it's now rolling over and it's being dragged down by the weekly. So this is definitely a orangey. You know, if this continues and it gets closer to the 100 level, I'd probably be inclined to make it a red reading, but I'm going to call it an orange one right now. So it was good and it's now rotating out of favor. Still has a way to go. And then we have materials. The monthly is improving, the weekly is rolling over. So that puts it kind of right in the middle with that weekly inside leading and the monthly inside lagging, moving at opposite rotations. So the materials sector, I made it an orange one because I do feel that this is going to be, you know, continuing lower, and the relatively short tail on materials inside lagging. It's still declining on the RS ratio scale. I don't see this as being a very positive constellation in terms of sector rotation. And here's real estate, and this is an interesting one because both tails are at a strong RRG heading, albeit at a very low RS ratio reading, but the improvement here is clearly visible, and so is the rotation on the monthly. So I'm gonna maybe boldly make this a green. I'm gonna call this an outperforming sector for the next couple of months probably, because this is a longer term move. It's got a lot of perspective. So real estate's going to be labeled as green in the sector rotation model. Now we got technology, and that is an interesting one. It is a strong sector on the monthly. We dipped a little bit, but it's moving to the right. And on the weekly, we are rotating back in. We're back into the weakening quadrant. By the way, this is quite rare, such a rotation that you go through lagging and then you cross back into weakening. So the rotation is weakening, lagging back to weakening. That doesn't happen very often, but as you know, these are the stronger rotations when you just start rotating back up and you move from weakening into leading. That's usually a good thing. So the technology sector also is going to be labeled as an outperforming sector. It's going to be green. And then finally, we have the utility sector. And that is an interesting one as well, because utilities are inside lagging, but starting to pull up. And we have a very strong rotation for utilities on the weekly. So utilities is also going to be labeled as green, as an outperforming sector for the coming months. And then we have the wrap up. So what does this all mean? As I said, consumer expectations, full recession, industrial production, full recovery, interest rates, full recovery, yield curve, early recession. So taking sort of the average of those four readings, and it's my educated guess, I think, would put this in the early recession. So we got a full recovery reading here, but we also have a full recession reading here, and then we've got one in the middle. So I'm going to say with this pool, it's going to be a little bit, so it's going to be early in the early recession time frame, early recession area. And if we bring that to the sector rotation model, maybe this needs to be slightly more to the right. So a little bit more here, early recession. And let me put this one then. So there you go. Interesting enough, so the sectors are not all that clear, except for tech, utilities, real estate, and then communication services on the other hand. But reading through it, you can see that the better sectors are all on the right-hand side. So staples, healthcare, financials, and then definitely utilities, real estate. And then, you know that you can sort of tech starts right here again. So it's all kind of biased towards the right-hand side of this graph, and it's definitely not on the left-hand side of this graph. And that means that the stock market, which is the orange curve, is theoretically well past its peak. And we know that in reality, or at least if we take the S&P as our gauge, is not yet well past that peak, but the underlying market is. So from that point of view, I mean, let me put it like this. The odds that we are in a full-fledged bull market with a lot of lags to go is kind of difficult to justify. I do see the market, I do see the S&P, putting in a new high, but I also see the warning signals, as we discussed a few times already. And here in the sector rotation model, we got it could be clearer, but it's not the worst reading that I've ever seen in terms of how aligned it is. And I'm pretty confident to say that we're past that peak. We're on the right-hand side. We're on the, early recession type area of the economic cycle. And we have not yet seen the market behavior, the broader market behavior that belongs to that part of the cycle. So caution still very, very necessary. And looking at the chart of the S&P 500, here's the weekly. And as we said, we just pushed to new highs, only marginally. So yesterday was 537.508, 537.595, just barely higher. And on a closing level, we're 537.532, so it's 0.5% higher than yesterday. But as we said, on a very narrow footing, and maybe more importantly here, if you look at the this is a PPO MACD type indicator, trend following, but it's not confirming that recent high, potentially putting in a negative divergence, and the same is happening with the RSI here on that weekly time scale. And if we bring that to a daily, we will see a little bit more detail, but the situation is the same, where the PPO is not being able to, or not yet being able to confirm that high in price with a new high in the PPO levels, nor is the RSI able to peak above its previous peak, so potentially putting in negative divergences. Again, those negative divergences mean nothing yet until we get a signal in the price chart. And to me, that would be, in terms of the S&P 500, a break below 53.30. I'm probably going to put the line in the sand here, 53.25, something like that, which kind of completes that topish formation right here. Anyway, that's it for today. Long look at the sector rotation model, putting it on the right-hand side. Sectors seem to be aligning, but the S&P is not yet responding, so we may be in for a treat, maybe not. Maybe everything digests with the market petering out more sideways. I don't know, but at least we've looked at it, and I think that the warning signals are definitely there. Whether they're going to materialize or not remains to be seen, but we can't ignore all these indicators. Thank you for watching, and I'm looking forward to seeing you again next week at a new video here at Stockcharts.com. Same time, same place.